Thinking about using an indexed universal life policy for infinite banking, before you make that decision, there's something you need to know about its history, rising costs, and hidden risks that people don't tell you about. Indexed universal life policies are often marketed as flexible tools for building wealth and retirement income, but the truth, they come with rising costs, unpredictable growth, and restrictions that make them a poor fit, especially for infinite banking. Today, we're going to dive into the history of IULs and how they evolved, how modified endowment contract rules changed the game, the hidden costs and risks of IULs that most agents won't tell you, and finally, a better alternative for infinite banking that gives you more control and stability. Stick around because at the end of this video, you'll know exactly why IULs fall short and what you can use instead for long-term financial freedom. First, let's get into the history of the universal life or the indexed universal life. So, universal life policies were created in the 1970s as a more flexible alternative to traditional whole life. They combined life insurance with a savings component, allowing policyholders to adjust premiums and death benefits. The problem with early variable life policies, by the 1980s, variable life policies tied to the cash value to market investments. But there was a problem. When the markets crashed, people lost both their cash value and their coverage. So these policies weren't really stable, and that's why you don't see this type of product very much around today. They do exist, but they are pretty rare. Next, in the 1990s, they rolled out what we now know as the indexed universal life. Instead of directly investing to the stock market, IULs tied growth to a stock market index like the S&P 500. The idea is very attractive. No market losses thanks to a 0% floor, great growth potential linked to market performance. But here's the issue. The growth is capped, often 10, 12%, and many of them don't even get that, while the fees and costs come out regardless of the performance of the policy. So the IUL seems safer than VULs, but the rising costs of insurance and growing limitations created their own set of problems. These problems mainly stem from the Modified Endowment Contract that was introduced in 1988. Before 1988, people could overfund life insurance policies, loading them with cash value while keeping the death benefit basically zero. This allowed them to grow their money in a tax-free environment without having to actually pay for the insurance that is in a life insurance policy. So in 1988, the IRS saw this as a tax loophole, and so they stepped in with the Modified Endowment Contract rules. So how the Modified Endowment Contract rules work is policies now have to maintain a minimum death benefit relative to the cash value. So if a policy violates these limits, it becomes a MEC and loses its tax-free growth and tax-free loans. So to avoid becoming a MEC, the IULs and VULs then had to require a higher death benefit, which means it costs more as you age, as a universal life product is an annually renewable term. The result is you get a rising cost of insurance that would eat away at the cash value you would gain, especially later in life. And if it does run out, you're forced to pay more to keep the policy in force or risk it just lapsing. The MEC rule turned what was once a flexible system into a time bomb for rising costs, and IULs and VULs are the ones hit the hardest. Next, we're going to look at the hidden costs and risks of IULs. So the first is going to be a rising cost of insurance. As you get older, the cost of insurance is going to increase with these types of product. Whether or not there's cash value is growing. So if the policy's growth slows or stops, these fees can eat away at your cash value, forcing you to pay more just to keep the policy alive. The second is going to be your growth caps and market risks. While IULs offer market-like returns, they come with caps, often 10% or lower, and the insurance carrier can change this at any time they please. So you can take out a policy with a 10% cap, and then they can lower the cap down to 7%, and there's nothing you can do about it because they'll discontinue the product and they'll just roll out a new one with a higher cap. So while it's higher, there's a lot more limitations that you can do. So even if the market grows 20%, you're only going to get a fraction of that. The next is going to be loan restrictions and living benefits. So here's what most people don't realize. If you have an outstanding loan on a policy, you may lose access to the living benefits like a critical illness or long-term coverage. That's a huge problem if you're counting on these types of features later in life. So while the IUL sounds great at first, but over time, fees, caps, and restrictions just add up, making them a risky option, especially if you're looking to try and do something like infinite banking. The better alternative is the classic alternative. It would be through a whole life insurance policy. Now, why whole life works better? It's not more so the growth, it's the guaranteed growth. The cash value will grow more predictable and tax-free without the market risks that the insurance carrier would be doing in an indexed universal life product. The next is going to be fixed costs. So the premiums stay level and they don't increase with age. As with a whole life, you're doing it over your whole life. The next is just going to be your dividends. Policies with mutual companies pay dividends that can be used for income or compounding growth, and you get more liquidity. So the loans obviously are tax-free just like the other one, and they don't impact the growth. But with whole life, what you can do is you can actually take out the dividend instead of the loans if you wanted to do retirement income and not restrict the living benefits that you have on the policy. You can just change your payout structure later to have dividends sent directly to you during retirement, creating tax-free income while keeping the policy alive indefinitely. Whole life insurance policies just provide predictability, liquidity, and stability, all the things you need for infinite banking and long-term income. To wrap it up, IULs might look appealing at first, but their rising costs, growth limits, and restrictions make them a poor fit for infinite banking and any sort of retirement planning. Instead, just go with a whole life insurance policy that guarantees your growth, your control, and it helps you build wealth over time in a predictable manner. If you're serious about setting up an infinite banking policy that works, or you're just unsure about an IUL someone's pitching you, drop me a comment below or just reach out to me on Instagram. I'm more than happy to help you guys. Please like, subscribe, and I'll see you guys on the next video.